The new fiscal year is only 2 weeks away, and customary FY24 outlook reports have started to come in. CRISIL is first off the block. The CRISIL report, in line with the consensus, says the GDP for FY24 will fall from 7% in this year to 6%. But what stands out in the report is their medium-term forecast. CRISIL expects the Indian economy to grow by 6.8% per annum in the next 5 years. What gives them this confidence, and who are the winners and losers of this growth story? I have with me two of the authors of the report, DK Joshi, Chief Economist, and Hetal Gandhi, Director, CRISIL Mkt Intelligence and Analytics. Hetal, DK, thank you very much indeed for joining us. So DK, first the tough one. How did you arrive at this 6.8? It's very encouraging, 6.8% over the next 5 years. But what gives you the confidence?
Well, I think we arrived at using a technique called growth accounting. And I think we typically do it once in a while. See, one couple of reasons why this growth will happen. And I also want to tell you what will drive it. So I think the number one driver will be the capital. So there are three drivers of growth: capital, labor, and efficiency. So number one driver is capital, followed by efficiency, and then labor is the least. Capital, because we are seeing so much of infrastructure investment happening. We are also seeing private sector getting ready for a staggered pickup in investment. So that is happening. PLI scheme is also helping. So we will see the capital contribution over the next couple of years rise. Efficiency, because you have invested in physical infrastructure, which reduces turnaround times, and there are several logistics related efficiencies that come with it. In addition to that, you have digital infrastructure, which also is efficiency promoting. Now, labor is the last, because labor we have ample supply, but the quality of labor at a national scale still remains a challenge. So I think these three factors are going to drive. And also we should remember is that in the last 3 years, we only grew at around a little lower than 3.5% per annum. So it's over a weaker base.
Okay, a weaker base, but there are people who are worrying about a bit of a historical slowdown, even pre-pandemic. So it doesn't worry you that therefore we may not be able to go to the 2000 to 2010 kind of pace?
Well, I think you can't always look at the rear view mirror and project ahead. I mean, so that would be looking purely at the rear view mirror. What happened has an impact, but I think there's been a lot of things have changed. I think particularly the infrastructure bit and the digitalization bit is going to contribute, I think.
Definitely to productivity. Okay, I have a few more things from there where you speak about low labor productivity. I'll come to that in a bit. But Hetal, do you think that CapEx is in an inflection point? I think your report says that government has come in and private CapEx is still awaited. Is that right?
Yeah, so there are patches in which capital expenditure is happening. The good part is that you are seeing balance sheet health very good. We look at 740 odd companies on a consistent basis, which are non-oil and non-BFSI. And what we see is that long-term debt, audited results of fiscal 22 indicate almost a 10% drop in long-term debt. Short-term debt has just gone above the pre-pandemic levels. And with that and good cash balances, you are looking at a net debt to EBITDA, which is a decadal low. So that gives you a lot of confidence. If I also split this net debt to EBITDA by the 30-odd sectors where we have companies present, you see that almost 75 to 80% of the sectors are seeing a sharp drop in net debt to EBITDA. So it is a rounded balance sheet health that we are looking at. On the other side, if you look at capacity utilizations or sweating of legacy assets, you see most of these sectors are now going above the 10-year average capacity utilization. But they have not crossed the peak utilizations that they someday reached, which means that they have some room. So they are sitting on the fence, in a kind of wait and watch mode.
Fair point.
And if you look at the first half numbers, it actually reconfirms this. So nearly 350 odd companies, industrial players, we looked into the balance sheets of those companies. And what you see is almost 50% of the capex was driven by only two sectors, which is oil and gas and metals, right? So we are clearly seeing that there are players in the metal space, cement, oil and gas, which are driving capital expenditure recovery. There are others who are sitting on the fence, especially where legacy assets are
Who's
concerned.
next off the block, you think?
So we do believe that new age sectors and PLI linked
renewable.
sectors, yeah, there you will see traction. New age sectors would be likes of semiconductors, green hydrogen, electrolyzers, wearable devices, where also some of the other government support has come in, where you will see a pickup in capital expenditure.
And in PLI, as you say.
Yes.
Okay. DK, let me go back to the earlier part of the report, which is very interesting, where you have analyzed the various inputs into GDP and their distance from the pandemic. You point out that exports have done best from the pre-pandemic bottom, and so has investment. But consumption has done badly. Can you give us more nuances? If consumption has done badly, that looks like a worry.
Well, I think exports, because global rebound always leads to a super growth in exports. So that's now not something new. When you come to investments, I think we already talked about it. I think that investments are slowly beginning to pick up, led by government so far. Coming to private consumption, so private consumption was very slow to pick up. So what happened was initially you got goods consumption because services were restricted. Then what happened in 22-23 is that the services consumption also picked up. So now you are, so what has happened is goods consumption is kind of moving towards its long-term trend. Services is trying to catch up. So you are caught in that, bind right now, where consumption will pick up, but led by services, not so much by goods.
Okay, so what sectors would you bet on then to take the baton from goods?
Well, I think the sector in services are obviously the hospitality, the airlines. These are still the lowest, weakest to recover. I mean, from the pre-pandemic levels, and these will continue to see maximum growth even in the next fiscal year.
Okay, got that. Now, what is? I'm trying to put two or three things together. You pointed out that the consumption and services have still not done as well compared to exports and goods and investment. You also point out that you are a little worried about labor and its contribution to GDP. All this gives me the feeling that it's going to be a skewed kind of development, more well-off and less for the bottom part of the K-shaped recovery, if you please.
Well, I think that's a trend that we have been seeing. I think it's not India-specific, it's across the world. I think the richer have got richer. That is why you have to support 800 million people with free food grains. That's giving you something. You don't have to do the same thing for others. But I think having said that, some correction is happening in urban areas because urban services are urban concentrated. Almost 2/3 are in urban areas. So when they pick up, they also spill over to various categories of. So that is why the PLF survey shows that the urban employment is improving.
Labor participation
is improving. Yeah. So that's and in that labor participation, the lower end also comes in.
Okay. Now a question to both of you, and either of you can pick it up. Would you say that this skewed K-shaped recovery, with the lower part not doing very well, can impede the pace of growth because not enough people are consuming?
It's difficult to say that it will impede the pace, but clearly what we are seeing is that there is a huge diversion in, kind of products which are getting consumed. So, for example, you are seeing that, cars as a space is showing double-digit growth rates. But within that, if I split between cars which are premium, more than 10 lakhs priced, and cars which are not so premium, below 10 lakhs, you're seeing that both in FY22 and 23, there was a huge growth that you saw in the premium category, almost 3x growth in the premium category, and another 100% growth in FY23 as well, whereas the growth in the non-premium category was substantially lower. So it is telling you that that trend has continued. It's not that it was just a one-year trend. It has continued in FY23 as well. We do believe that the gap will keep coming down, but the gap will remain. Okay. And that we are seeing across categories. You look at hotels, you look at premium hotels and,
budget hotels.
The budget hotels, there is a difference in the way utilizations are improving or even room rates are improving.
Okay. Yeah, I went on, you even point out that old ACs and split ACs, you can see
yes.
the premium ones are doing better than the cheaper, older ones. DK, what about exports? I mean, even now there is a bit of a jitter on the rupee. Do you think that will, because you're speaking of a global slowdown, pulling down the rate of growth next year, will exports be a concern?
Well, exports are a concern in the sense that the two of our major trading partners are expected to slow down sharply, which is Europe and US. So I think it will spill over to us. Even I think right now, if you notice, the export growth is negative.
Yes.
And reason for that is US is not doing badly right now, but their consumption pattern has shifted towards services from goods. When you consume services, you don't import that much. So that is playing out currently. Next year will be, or this year, next 9 months will be a period when the US and Europe do slow down. I think then the other merchandise exports will get impacted even more. But there are some pockets of resilience where I think Hetal has done some work. Maybe you should point out.
Yeah, I think, when you look at exports and when you look at past downturns, you see that countries which have more commoditized exports actually tend to get impacted much more sharply.
Which ours are.
Yes, during downturns. What has started happening, and when you split your top 10 verticals and look at those verticals, you see the same trend. You will see pharma, medical devices, not really getting impacted so much, but all the other categories, you will see a very sharp impact. What we are seeing now is that, as DK pointed out, you will see a structural pull down that's happening to exports. But there is also a support that is coming in because a lot of PLI capacities are getting commissioned. And, there is almost $150 billion worth of potential that the government has highlighted. All of that can immediately not come in. But as the capacities get phased off, you have an opportunity where you can do an incremental $25 billion worth of exports in the merchandise category thanks to these capacities getting commissioned. That will provide some support, and hence the kind of drop that you may see will not be as you have seen in the past.
Oh, yeah. That's a positive.
Yeah.
Okay, now to the dangers to your forecast. I mean, a broad brush appears to be inflation and, in the medium term, climate. Can you add a little?
Well, I think inflation is a worry currently. I think, and the worry is more from the weather side. I think you already had a heat wave, and wheat inflation rose, cereal inflation rose, and we are still suffering. And there's another heat wave in the making, so to say. It's not materialized fully as yet. And on top of that, you have El Nino prediction which means less rainfall. So I think food will be one category as far as inflation is concerned that will need very, very close monitoring. So I think weather-related shocks are also important, apart from the fact that core inflation still continues to remain very sticky. And I think some pipeline pressure on core is reducing as visible in WPI. But I think there is still margin pressure also on the company. So they will, I think, try to use it as much as they can. So I think this is the climate side, I think, of inflation, which is a worry. The second question I think related question you had was, sorry.
No, which are the two risks to growth? That was my question.
Yeah, I think this is clearly one. The second, I think, risk to growth, you can look at it the West. I mean, how volatile the situation is. If the downturn there is more severe, I think that will clearly spill over to us. But I also wanted to point out, I think, just to add to the previous question, if I may, I think what is happening globally is a growth rotation. China is picking up, US and Europe are slowing down. That is net negative for India because we export 6 times more to Europe, which is coming down, and US, which is coming down more sharply than to China. We hardly, but some other countries like Australia, etc., will benefit a lot from this growth rotation. We will not.
Well, hopefully the China Plus One will lessen the negative for us. Take your point on that. Thank you very much, Hetal and DK, for whetting our appetite. We will read the report more closely and come back with more questions.
Thank you.
Thank you.
Well, that's it on this edition of It's the Economy. Time for Chartbusters.